I'm Priscilla Barrera with the Investing News Network, and here with me today is Anthony Milewski, Chairman and CEO of Cobalt 27. Thank you so much for joining us today.
Thanks again, and it's great to catch up with you. I think the last time we chatted was at PDAC.
That's right. And today we're here at the Lithium Supply and Markets conference, and we just had an EV briefing day, which is coming to an end. What is your main takeaway so far?
I think, my main takeaway when I look around the room is that battery makers are here, automobile makers, producers, really the entire value chain, traders, and the excitement about the acceleration of the adoption of the electric vehicle is electric, to make a pun. But the investor community really isn't here, and it's sort of interesting to see the actual adoption of these vehicles accelerating, and really, I would say, not a true representation of the investor community here. And I don't know if that's because of the time of year, or if there's just not really the understanding of the impact that these technological advances are going to have, namely the EV is going to have on these basic materials.
All right. And you were at a panel today on cobalt, nickel, and graphite, and one of the main questions was regarding cobalt and how can the supply side keep up with demand. You talked about geographical risk and not so much about actual supply. What are your thoughts on that? Can you talk about that?
Sure. There are a number of projects that will come on in the coming years. You have Katanga and RTR in the Congo. You have clean tech under construction in Australia. And then, you might have seen recently, we just, along with Wheaton Precious, did a $690 million stream on Voisey Bay Underground, which will produce cobalt and nickel as well. So, we do see a pipeline of projects in the coming years that will actually bring supply into the market to really fuel these electric vehicles. So, for us, I don't foresee cobalt being a bottleneck so long as the price remains high enough to incentivize these mines as co-products, I should say, because cobalt is a co-product, but that helps incentivize these mines to be built and really produce.
All right. But you are a believer that the DRC will be the main supplier, in a sense, of cobalt even going forward. So what can, on the supply side of things, we will have enough supply, but there's a risk with the DRC, right?
Absolutely. In fact, in coming years, the concentration is going to grow inside of the Congo. So if you say today, for the sake of a number, 65% of cobalt is produced in the Congo, as RTR and Katanga come online, that number approaches 75%. So, think about OPEC at its peak, was it 50%? I don't know offhand what the number was. It was nowhere near 75%. So certainly the key risk from my perspective is not, it's not price, it's not, is there enough cobalt? Instead, it's just simply risk associated with concentration, and concentration in a difficult place, namely the DRC.
All right. So if the DRC will continue to supply the cobalt market, how can we ensure the supply chain is clean of human right of uses, which is one of the main topics right now in the market? How can we manage the supply to reduce or eliminate that risk?
So at Cobalt 27, what we've done is just represented to our shareholders that we're not going to invest in the Congo. So, obviously with Voisey's Bay, you have a world-class operator, world-class mine, and a world-class jurisdiction. Ramu, the same type of thing. World-class operator again, a known mining jurisdiction. So that's how we've avoided it. But I think ultimately the automobile industry is not going to be able to avoid it. And so there are a few steps. I think the first one is, buying from mechanized miners. So if you are buying from Glencore, you're fine. I think you're going to be just fine. Ultimately, though, these companies are probably going to have to buy from artisanal miners. And what's going to be important is that processes get put in place, and whether that's, fencing and monitoring people going in, whether it's a blockchain application, I don't think we know the answer yet. In tin, when they had the problems a number of years ago, they bagged and tagged it. But I think that the industry is going to have to develop a solution for monitoring that cobalt all the way back to really the first shovel of dirt, in order to give confidence to the entire supply chain that we're not actually, putting this conflict cobalt into our devices.
All right. And this morning there were also some panels that talked about the upcoming technology and how the chemistry will change in batteries and the batteries that are coming going forward. And how that will impact metals such as cobalt and nickel. What are your thoughts on that?
Yeah, look, I think it's much ado about nothing. So much airtime and noise gets given to this topic, but if you actually are able to sit down with battery makers and really talk with them off the record, we hear the same thing over and over and over again, which is the overwhelming majority of CapEx is going into the NMC battery. Everyone on Earth is basically using that battery, save it for Tesla, who uses NCA. And so any advances it's going to follow will be in developments of that NMC technology, because that's where all the money's going. It's very straightforward, very simple. So for the foreseeable future, like what we think and see is that the 622 is ultimately going to be the NMC chemistry of choice. And it may well be the chemistry of choice for a decade. That's not to say that the 811 won't be ready in a few years, but I think you're going to have degradation issues there, thermal runaways decreased, and frankly, for adding a couple more bucks to your price of the car, we think a lot of battery makers and automobile makers are ultimately going to decide that the stability, the rechargeability, and the range in that battery warrant staying at 622. So, battery costs will continue to be reduced around the housing and sort of things like that. I think if you want to look out 10 years, ultimately you probably get to a solid state battery. Maybe you replace graphite in whole or in part with silica or something of that nature, which allows you to effectively go down to an 811 or a lower chemistry. But by that point, whether it's 8 or 14 years out, I don't know. But by that point, the penetration rate of electric vehicles will be so material, in my view, that the impact on nickel and cobalt will be such that you'll actually need that shift and that adoption. So, we think the path forward is very clear. It's an NMC future for this foreseeable future, and all developments are really going to be around that NMC chemistry because that's where all the CapEx is being spent.
All right. And what are your thoughts on cobalt recycling?
Look, it's a very important part of the whole kind of value chain. I mean, by the way, cobalt metal recycling already exists. I mean, there's not really much to say about it. It's just part of the system now. I think for batteries, it's slightly different. So, when we talk to GEM and some of the other companies, we feel that the technology is there today. It's that the supply or the feed into that is probably not there. So, the life of the battery is kind of between 7 and 14 years for the first life of the battery, namely in the electric vehicle. You probably have another kind of 5 to 7 year life for that battery in the sense that you put it into a grid stabilization field. You may get 20 years out of the battery life. So with car crashes and malfunctions, I think cobalt recycling from EVs is probably not really a major part of the market for another 10 years. However, someday, and that will really be a function of penetration rates, I think it will be a very much important part of it. And I think, like I said, when we talk to GEM and some of the recyclers, I think that technology is well advanced. It's just there's not the supply or the feedstock of batteries yet.
All right. So looking ahead to the second half of the year, what do you think is ahead for the cobalt market? What factors should investors keep an eye out for the rest of the year?
No, so it's now almost July. In the summer you have some of the end users of cobalt shut down their plants. You're reaching the kind of the end of the annual contracting cycle, and so cobalt is not particularly interesting in July and August ever. So what I would kind of think happens is that starting in September, the mating season starts, which is when consumers and producers start to get together and think about their annual contracts. By October, when you have LME week, it's in full swing. And, I would suspect that this fall we will finally see some big deals with automobile makers and producers of cobalt. And I think that sentiment will drive the market hard. So, if you're an automobile maker and one of your competitors, whether it's directly or through the battery maker, secures, their basic raw material needs, I think it starts to put pressure on you. And so I anticipate that one of the drivers of interest for Q3 and Q4 this year is going to be long-term agreements from battery makers and automobile makers starting to come into the market.
Let's talk a little bit about Cobalt 27. It's been a busy year for your company. Most recently, as you mentioned before, you signed a streaming deal with Bale. Can you talk a bit about that and what it means for your company?
Sure. Yeah. This has been a year that I never could have planned. We did an IPO, a bought deal, a big royalty deal. Then we did Ramu, kind of 4 weeks ago, which is $115 million nickel cobalt stream. on one of the best nickel cobalt mines on earth. And then, just, kind of 10 or 14 days ago, we announced a stream on Voisey's Bay. So for us, the last kind of 4 to 8 weeks has been transformational. We've moved from being a company that had 3,000 metric tons of cobalt and a dream to being a streaming company with streams on 2 of the best assets in the world for nickel cobalt and a couple of great royalties. So this has really been a defining kind of month and a half here as we've executed these transactions. And now looking forward, you've got those cobalt flows going out decades. You've got exposure to nickel just vis-a-vis the structures that we've created. And we think that, as the adoption of the electric vehicle accelerates, as grid storage thematic rolls out, that we're going to be probably the best positioned for investors who want to express a view on cobalt and ultimately nickel.
Right. And going back specifically to the streaming deal with Vale, were you surprised about Wheaton Precious' decision to join that deal? Meaning they're precious metals and they're going into a cobalt stream.
Yeah, look, I can't speak for another public company, but I think when I look across all the streaming companies, or a lot of them, you've got Franco, which has a bunch of investments in oil and gas. You have a Cisco that has a big diamond investment. So, it seems that there's a trend inside of the streaming and royalty business to have, call it 20, 30%, whatever the number is, in world-class, high-quality streams that maybe aren't in whatever your core focus is. So it didn't surprise me only because it's a world-class stream, and I think that if you're a streaming and royalty company, no matter which one you are, you want to be a part of those transactions. So, it's great to have them in. I mean, these are sort of the big boys, but not surprised just based on the nature of the stream and the counterparties involved.
All right, and my last question for you. What's next for Cobalt 27?
Yeah, look, we're always looking at things and thinking about the future. I think now, having just really completed a massive capital raise of $300 million, we've got to give the stock some time to season, let the share price appreciate, let people come back from the summer in the fall, and let things re-rate and then see where the world is. But we're always thinking about ways to increase and enhance shareholder value. And, I think the next step will be, and we've press released this, is that the Ramu transaction was really $200 million, and we have completed $115 million of it. And I think, with our credit lines, sometime later this year, we would look to create the balance of that stream or close the balance of the stream for another $85 million without raising any equity and just using our credit lines.
Right. Thank you so much for joining us today.
Thank you very much for having me. Always a pleasure.